Hey everyone, thank you for joining us today for our webinar on year-end financial planning. And it's from the perspective of an accountant, estate planning attorney, and financial advisor. Today's webinar will be presented by Yuri Yu, Donna Lee, and Sophia Kim Sakamoto. Yuri is a certified public accountant and her office is located in Fullerton, California. Donna Lee is a certified financial planner and her office is located in the city of Orange. Sophia is an estate planning, probate, and living trust attorney with offices in Buena Park and Mission Viejo, California. If you do have any questions during the webinar, please put them in the chat box below and we will answer them at the end of the webinar, time permitting. Of course, here's a little disclaimer, right? Nothing here is any legal or tax advice. There's no attorney-client relationship in this information. If you do have any questions, put it in the chat, and if we can't get to it, we'll try to answer them after the webinar. And you may have already noticed that the webinar is being recorded. If you do need to make a screenshot, we discourage that. Please let us know beforehand if you want to do that. All right, well, let's get right into it. Of course, this webinar is about year-end tax planning. So Yuri, what exactly is year-end tax planning?
Yeah, year-end tax planning, it's when you analyze your financial situation from a tax perspective. You calculate a projection of your tax to see if there's any opportunities or strategies you can put in place before the end of the year to get to the most efficient tax result. So next slide, why do I need year-end tax planning? One of the main reasons tax planning is important is so that we can look for strategies to lower your overall tax liability, not just in the current year, but in the future as well. Another great reason is so that you can estimate how much tax you're going to owe with your return so that you can budget for it. You know, nobody likes being surprised with the tax bill. So this way, at least you have, several months to set those funds aside rather than getting your return done in like April and then you have to come up with the money to pay your tax like within a couple of weeks. And if you're a W-2 employee, it could help you figure out if you're having enough taxes withheld from your paychecks. And if not, you can make changes to your withholdings before the end of the year to help reduce what you're going to owe with your return, and also, make sure that you're properly withheld for the following year. Because, say it turns out that you are under withholding from your paychecks in 2021, but you don't realize it until you do your return in April of 2022, then you're going to have to pay what you owe for 2021, and then you're also going to have to catch up for what you've under withheld for 2022. So it can, be a lot to pay out at once. So this is the time when, year-end tax planning could be useful for you. So when do you need year-end tax planning? I think it's most important in years when your income is changing. So when your income is higher than usual, so maybe you received a large bonus or a commission, sold stocks or property for a large gain, you want to buy a house, you want to liquidate some stuff, and so you have some gain you're going to recognize, or maybe your business just had a really good year. And also when your income is lower than usual, that's not something that people will usually know, but yeah, when your income is lower than usual, there could be some tax planning opportunities there as well.
That's actually one of my favorite times to do tax planning.
Yeah, it's something that people don't really know about, but definitely there are some good opportunities there. And that could be because maybe you took some time off because you had a child, or maybe you started a new business. Anytime you start a new business, a lot of times you'll have a lot of upfront startup costs. So in those years, maybe your income is lower than it usually is. If you own a business with fluctuating income, which really it's most businesses, it's really hard to project what your business is going to earn every year. But there can be some tax savings opportunities there. And in years when there are changes to tax laws, which has been, a lot in the last couple of years. It's usually not this crazy, but it's been very exciting in the tax world lately.
Okay, so Yuri, do you think November is kind of a good time to talk with an accountant or financial advisor about tax planning?
Yeah, November is a great time, actually. March, April, it's probably too soon. Also, accountants are very busy during those months, so don't ask us. Try to minimize your questions during that time. And there's just too much time for things to change. But by November, you have a pretty good idea of what your income is going to look like. So it is a good time for year-end tax planning. But if you had some kind of extraordinary event during the year, like you sold the property or you got that big bonus or whatever, whenever that event happens is probably a good time to reach out to your accountant or your financial advisor or whoever else helps you with these things.
Okay, great. So what are some strategies then to consider when doing some tax planning?
Yeah, so there's kind of like two strategies, like I kind of split it up into two ways. One is when your income is higher than usual or your tax rates are high, and then the second is when income is lower than usual or your tax rates are low. So when your income is higher than usual or your tax rates are high, you want to defer income if you're able to. So say you wanted to sell a bunch of stocks and that gain is going to push you into a higher tax bracket. Maybe you can sell some of those stocks now and you can sell the rest in January to avoid, you can avoid that higher tax bracket. So you sell just enough to get to the end of the low tax bracket without pushing you into the next one. Another thing you want to do when you're in a higher tax bracket is accelerate your deductions, because you're going to get a bigger tax benefit for those deductions in a high tax rate year. So you make sure you max out your retirement accounts, do all those, make those donations that you were planning to do. And then another thing that people talk about a lot is tax loss harvesting. And this is where you recognize unrealized losses on stocks that you're holding, and you can use those losses to offset capital gains. Personally, I think this works best when you have short-term capital gains, because those are taxed at your ordinary tax rate versus using them against long-term capital gains, which are taxed at a lower tax rate. But it really depends on your situation, how much gain you have, how much losses you have. So I just wanted to bring that up, but just know that it may not be the best answer for everyone, and you really should probably advise, talk to your financial advisor, your accountant too, if that's something that you're considering. When income is lower than usual or when tax rates are low, you want to accelerate or recognize income in those years since it's going to be taxed at a lower rate. And you'll, if you can, hold off on some of your deductions like donations or business expenses. This is also a good time to convert your pre-tax retirement accounts. So if you have like a traditional IRA, this would be a good time to convert it to a Roth. That conversion will be taxable, but at least you'll be paying tax on it when you're in a low bracket. And from that point on, the account will grow tax-free. So a lot of tax planning is like playing with the tax rates. You're trying to look ahead a year or two to find ways to minimize your taxes, like your overall taxes. So say you're normally in the 24% tax bracket, and every year, without a doubt, you donate $10,000 a year to charity. In a normal year, that $10,000 donation reduces your tax by $2,400, $10,000 times 24%. But say you had a really good year and you're going to be in the next tax bracket up, which is 32%, that same $10,000 donation is going to reduce your taxes by $3,200. So that's an $800 difference just from playing with the tax rates. So instead of giving the same $10,000 a year, you can bunch your donations into the years that you're in a higher tax bracket, so you're getting the biggest tax benefit. Or it works the other way too. So maybe your income is really low this year, so you're in the next bracket down, which is 12%. So that $10,000 donation is only going to reduce your taxes $1,200. So in that situation, it's better to wait. And you can just wait until like January 1st of the next year, make the donation in the year that you're in a higher tax bracket.
So Yuri, sorry, go ahead. Did you have more to say?
No, go ahead.
I was just going to say a lot of this seems like it would be beneficial for business owners because they can kind of play around with their income and kind of push it. Or, but what if you just have like a steady W-2 income, or what if you have no income? Is there any tax planning strategies? I mean, is that beneficial?
Well, definitely if you have no income, you can utilize some of those strategies like bringing in income, converting some of your pre-tax retirement accounts, maybe recognizing some capital gains because there is a 0% capital gain rate. So, you know, you could recognize gains and not pay any tax. So there are things definitely that you can do when you're in a you know, if you have no income.
That's the best time to plan, to be honest.
Yeah, yeah. So yeah, I mean, yeah, if you have a business, I mean, I feel like every business owner should do tax planning every year because you do have more control over your income and deduction. So if you know your income's going to be high, you could go out and like hustle, you know, not hustle, the opposite, not hustle, purchase that piece of equipment that you've had your eye on or hire someone or whatever. But if you know your income is going to be low, then you could try to like hustle and bill and collect on from customers to bring in income. But you know, as an employee, you don't really have control over your income, but you do have control over your deductions. And there are things that happen outside of our regular W-2 job that do affect our taxes. So, you know, personally, I do still feel like a lot of people could benefit from tax planning, but it really does depend. If someone approaches me and asks, I'll kind of look at their situation and I'll say, yeah, this is probably a good thing for you to do this year. Or I'll say, you know, your situation's pretty simple, maybe not this year. Me personally, I do like my own tax projection like every month just because I can. And I don't like surprises, but yeah, I still feel like most people could benefit from it.
I mean, just to give an example, I have a client that has a W-2 salary and he wants to convert some of his pre-tax accounts over to his post-tax accounts. However, we're always taking a look to see what his income is for the year because we don't want to convert too much where it pushes his income over a certain threshold and then he cannot contribute into a Roth IRA anymore. So something simple like that, it's always good to just to know some of the tools that are available to you.
Yeah, and then as your income gets higher and higher, different rules come into play. You know, credits might be limited, deductions might be limited. So it is good to kind of, you don't want to just think of your tax situation with just that one thing. You want to make sure you're taking a look at everything together because like everything is related. That's why anytime someone asks me a question, there's like no simple questions. Everything's like, it depends. And I have to ask like a ton of follow-up questions. It's just because tax laws in general have gotten very complicated over the last couple of years. Even though they keep saying they're going to simplify it, they keep coming out with new laws and it is not simple at all. So yeah.
Yeah, and speaking of tax law changes, I know there was some activity this morning in the House. Maybe Yuri, can you go over some of the proposed tax bills?
Yeah, so okay, so first there was the Infrastructure and Jobs Act that passed last week. It was signed into law by President Biden just this past Monday. There wasn't too much in there about taxes. It was mostly about, you know, infrastructure stuff like roads and bridges and things like that. The big tax bill that we are waiting for is the Build Back Better Act, BBB. Now, you probably heard that, yeah, the House voted on it this morning and it did pass, but so now it's going to go to the Senate. So it's not a done deal yet. There's going to be changes. It's not law. It's not final until the president signs it. And at this point, I'm hearing that that might not happen until like maybe Christmas. So we really don't know. The good thing is that there's not much in it that's retroactive. That was kind of what we were really worried about in the beginning of the year, that they were going to make all these changes and increase rates for everyone, and it was going to be retroactive. It's so too late for us to do anything to plan for it. But it seems like most of the retroactiveness of it has was off the table. So I just listed here like some of the things that I feel like would affect the average taxpayer, things that I get questions about and have gotten a lot of attention in the media. So increased tax rates in general are off the table. We're not expecting any increases to the personal tax rates or capital gains tax rates. In lieu of that, they are introducing a new surcharge tax of 5% for income over $10 million for individuals or $200,000 for estates and trust, and another additional 3% surcharge tax for income over $25 million for individual taxpayers or $500,000 for an estate and trust. This is starting in 2022. The other thing is the revised SALT cap. So SALT stands for state and local taxes, and this includes state income tax and property taxes. So starting in 2018, this SALT deduction was limited to $10,000, and that hurt a lot of taxpayers in our state, California, since our tax rates are high and our property values are high relative to a lot of other states. So the House bill that just passed increased the $10,000 cap to $80,000, but it also extended, so that $10,000 cap was supposed to expire in 2025. Now the $80,000 cap is going to expire in 2031. So they had to do that to kind of like make it meet the budget stuff. But I think there's going to be more changes to this. They keep talking about it, so they could change that cap. They could introduce an income limitation on when the cap kicks in. So we'll just have to wait and see what happens here. And this is at this time retroactive to 2021. So this would affect our 2021 tax returns. Another thing is they are talking about expanding the net investment income tax. This is a 3.8% tax that applies to net investment income once your income hits a certain level. So before, this only applied to like interest, dividends, capital gains, and passive income that was reported to you on a K-1, but they might start applying this tax to like all trade or business income. So if you're an active owner in an S corporation or an LLC, this could affect you. If your income is over $500,000 for joint filers or $250,000 for single filers, and this would start in 2022.
This one is a big one for all clients that are business owners that have S Corps, because one of the main reasons why you probably set up an S Corp was for that passive income, was for that K-1. You minimize your W-2 and maximize your K-1 reasonably. And if they're going to start taxing that at a certain income, this is going to be a big deal, I think.
Yeah, I mean, there's a lot of stuff that affects K-1 owners as well. We don't know how this is going to affect the 20% qualified income deduction and payroll taxes. Like all these different taxes come into play. You increase one, this tax goes down, this other tax goes up. So there's a lot of planning opportunities here. So this is where I say, yeah, if you own a business and you can control your entity structure, you can control the wages and your income, tax planning could help a lot with that. Retirement accounts, they were talking a lot about retirement accounts, I think, ever since that article came up with that billionaire that had a ton of money in a Roth, and everyone was all angry about it, but I guess they're not angry anymore. So that's off the table. But they are talking about, I think the recent House bill, they're no longer allowing backdoor Roths, which Donna's going to talk about. And then they got rid of the removal and then they put it back in. So I don't know. I don't know what's going to happen here. They might change this again.
Well, the big thing with retirement here is that they don't want to have anyone have too large of an IRA. So if your IRA account goes to like 10 million or 20 million or something like that, you have to take it all out or take out half of it or something. So those numbers are still being played with. It's not finalized yet, but that's really the intent behind these retirement account changes.
Yep. Stepped up basis and appreciated assets. There was some concern that they were going to get rid of this. This is when you inherit something and you get a step up in basis of the value at the time of your inheritance. But that's off the table, so you don't have to worry about that anymore. Paid family leave, I'm not really sure what's going to happen here. I think at first they were going to provide 16 weeks, then it went to 4 weeks, then they got rid of it, then they put it back in. So we're just going to kind of have to see. Luckily, we're in California. Our state has paid family leave, so I'm not sure how this would have affected us anyway. Child tax credit. There were some changes to the child tax credit early this year from President Biden's American Rescue Plan Act that was signed in March. It increased the amount of child tax credits in 2021 and provided these monthly advances, which, I mean, honestly, the IRS has made a train wreck out of these. So it's going to be really fun dealing with this next tax season. Anyway, they're extending this program to 2022. So overall, child tax credits are bigger in 2022. And the reporting of cryptocurrency transactions. This was a part of the infrastructure bill that was signed on Monday. So this is final. They're going to require cryptocurrency exchanges to report transactions to the taxpayer and to the IRS on a Form 1099. This doesn't take into effect until 2024. So I'm sure there's going to be a lot more that gets figured out on this, on how it's going to work.
And Yuri, really quickly, I know in the news there was something where if you had $600 in the bank, like they had to report it to the IRS. What happened with that?
Yeah, so this is where, they say that there's like huge tax gap between what people report on their returns and what they don't, and it creates this big gap between, of unpaid taxes. So the IRS they were gonna have the banks report on like a 1099 form the total amount of withdrawals and deposits from accounts. First, the limit was $600, then it was $10,000, and now it's gone. So it's not something we have to worry about. I know people are very concerned about that with privacy and everything else, but it's off the table as far as I know.
Great. All right. So, now we know we should do some tax planning. Donna, what things should we consider before December 31st?
So December 31st is a major deadline because it's the end of the tax year. So anything that you want to get done for this tax year has to be done by December 31st. So just to review, the IRS has these limits set up for your 401k. The same limit applies to 403b, 457b. By the way, all these numbers, those are just sections of the IRC, the Internal Revenue Code. So it just depends. 401k is for businesses, 403b is for teachers, 457b is for government workers, and solo case. And the salary deferral amount is $19,500 for the year. And if you're over 50 years old, it's an additional $6,500. This is only referring to your salary deferral. So that means you're deferring your salary. This does not include any employer contributions or any matches or any of that. Okay. The IRS limits for IRA and Roth IRA contributions is $6,000 for 2021. Again, if you're over 50 years old, you have an additional $1,000 you can put in. The top four, the 401k, 403b, 457b, solo K, the salary deferral amounts have to be in before 12/31 because they are deferring your salary. Again, because it's referring to your salary, it gets deposited through payroll. And payroll has to run before December 31st. IRA and Roth IRA contributions, you actually can make up until April 15th of 2022. Traditional and Roth IRA contribution rules. So I get this question a lot. This applies only to contributions only. It does not apply to rollovers or conversions or transfers. So if you converted something, or you took an IRA and converted to a Roth, or you transferred from one IRA to another, or you did a rollover, that does not change the amount that you can actually contribute. So contributions simply refers to money that is not in the retirement account and now it's put into the retirement account. So for you to contribute into an IRA or Roth IRA account, you must have earned income. So that would be a W-2, or passive income does not count. So if you have rental properties and you're collecting passive income, that does not count. If you only have a K-1 from a partnership, that does not count. It has to be earned income, which makes sense. You must have had to work to be able to retire. There is no restrictions on age. So you can open up an IRA or Roth IRA account if you're 1 year old or if you're 99 years old or 100 or whatever. There is no maximum or minimum age to do this, which means if you have any children that are working, they are able to contribute into a traditional or Roth IRA, probably a Roth though. And in the past, there was a restriction on a maximum age. Now there's no maximum age. You can as long as you're still working, you can still contribute into these accounts. The Roth IRA, there is a phase out. So what that means is if you make too much money, you actually cannot contribute into a Roth IRA. So depending on your tax filing status and your modified adjusted gross income, you can see that the maximum contribution decreases. So let's just take a quick example. Let's say you're married filing jointly and your modified AGI is under 198. Let's say it's 180. Then that means both husband and wife can both contribute $6,000 each into their IRA or Roth IRA. Let's say you're married filing jointly and your modified AGI is 210. So that's over the 208. Then neither of you can contribute any into your Roth IRA. Sorry, I think previously I said IRA. This is only pertaining to Roth IRA. And then let's say you're married filing jointly and your modified AGI is right in the middle between 198 and 208. It's at 203, 50% in. That means both of you, husband and wife, can only put in 50% of the maximum, which is $3,000 each into the Roth IRA. And so make sure that you know what amount is the most that you can put in, because just because the IRS max contribution is 6,000, you may not actually be able to qualify to put all of that in. And if you over contributed, you have to back those out. You have to withdraw those excess contributions. As long as you catch that before you file your taxes, so before April 15th, you're fine. It's just paperwork, and we just pull out the excess contribution that was put in. Otherwise, there will be penalties. If you are a business owner, regardless of your entity status, whether you're sole prop or incorporated, or you're just a partnership, one thing that you do have at your disposal, one retirement account you have, is you can opt to do a solo K. So I bring this up because it's basically like a 401k for a small business for just you. You have no other employees besides immediate family members. Partners are okay. But these accounts must be set up by the end of the year. So if you're in this boat and you're considering ways to lower your taxes, you may want to consider setting up one of these accounts, opening it up by the end of the year. You have to do so to be able to contribute into that salary deferral bucket. Remember how we talked about it a couple slides ago? The maximum contribution is $19,500. You can do that, but it has to be done before 12/31. Let's say you have a solo K, you've had it all year and you've been putting some in, or maybe you haven't been putting anything in, and now you're looking like, oh, okay, I really want to put money in for whether it's tax deduction or saving for your own retirement. One thing you can do is you can consider bonusing yourself. So remember that $19,500 must come from salaries, which means it must run through payroll. So even though there's only maybe 3 payrolls left by the end of the year, if you're running payroll every 2 weeks, maybe you can consider bonusing yourself to boost up your income for the year, and therefore take that excess and put that into your salary deferral if you haven't maxed out that $19,500 yet. And that way you can max it out to the 19,500 or more if you're over age 50. Backdoor Roths. Now, this will probably be the last time I talk about backdoor Roths, and this is one of my favorite topics, but it'll probably be one of the last times, depending on what happens with the Biden tax plan. But one common issue that I run into with clients is you guys make too much money and you cannot contribute into the Roth IRA anymore. So what do we do? So this will probably be the last time we can do this, but here's a solution that we can use. So the problem is you and your spouse make $300,000 and you can't utilize any of those tax benefits that we talked about previously. You cannot contribute into a Roth IRA because you make too much, and you cannot get a deduction when you put money into an IRA because you make too much, probably have another 401k at work and such. So what do we do? So the solution is a backdoor strategy, backdoor Roth. And what that means is it's kind of a backdoor way to get money into a Roth IRA. Since you can't go directly into a Roth because of your income, we are able to contribute into a traditional IRA. Now, you may not get the tax deduction, but you're essentially just contributing after-tax dollars into that traditional IRA. And then once you do that 6,000, right, that's the max for the tax year, you don't get a deduction, you immediately convert it over to a traditional IRA. And to a Roth IRA from a traditional IRA. So the trick here in this strategy is to convert immediately to limit the gains. If you put money into that traditional IRA after tax, and then you wait 10, 20 years before you convert it, then there's all these gains in here that you would have to pay tax on. But if you put the money in right now and you convert it a week later, there's very minimal gains, if any. So that way you're not paying any taxes to get that 6,000 into that Roth IRA. And now that the money is in the Roth IRA, it follows the rules of the Roth. And it's just another way to get money into the Roth IRA without going directly into it. Now, I will mention here that if you're going to be using any type of tax strategy, make sure you talk to your CPA or financial advisor, make sure they understand what's going on and that they're okay with it. because anytime we do any type of tax strategies, there's going to be tax forms that need to be completed, and if not, you won't be very happy. We have to go back.
Yes, especially when you do a backdoor Roth. You do have to fill out a Form 8606 and attach it to the tax return in the year you make the contribution and in the year that you convert it. And you're gonna get a 1099-R when you convert it. Sometimes this is one of those forms that people have to like log into their account and download, and so they'll forget to do that and whatever. So if you ever do a backdoor Roth, make sure you tell your tax persons, because there is some stuff we'll have to do on your return for that.
Yeah, and it sounds like if this is a strategy you're going to use, better get that done soon before it goes away and you're not able to do it anymore.
Yeah, that's why I say this is probably the last time we'll talk about it, because again, even though it's not finalized, it is definitely on the table, and it's something that they're just going to eliminate completely. There were talks about keeping it for those over a certain income threshold, but they're going to take that away. Before I get to Roth IRA conversions, I'm going to mention one last thing about the backdoor Roth, super backdoor Roths. So it's like the same concept, except instead of IRAs and Roth IRAs, we're talking about your 401ks. So the limit is significantly higher. It's not just the 6,000 that can go in. If your employer has a 401k that allows for after-tax contributions, this is the last year possibly that you would be able to do this. You would put money into the after-tax portion of the 401k. This is not the same as a Roth 401k, the 19,500 salary deferral. It is not that money I'm talking about. This is a separate bucket in your 401k that is after-tax contributions. Not every 401k has it. Not every 401k allows it. But if yours does, what you can essentially do is you can contribute the maximum into there, and then again, immediately roll it out, convert it over into a Roth IRA. This will probably be the last year you can do this. So check with your 401k provider, and then make sure you definitely talk to the CPA and or financial advisor. Roth IRA conversions. Okay, so the reason why after-tax backdoor Roth IRAs are probably going to go away is because the government is going to limit any type of after-tax IRA conversions. So they're not going to allow that anymore. But Roth IRA conversions are not that. Roth IRA conversions are purely pre-tax IRAs that you're converting over to a Roth IRA. So there is a difference. So make sure you realize and distinguish that certain IRAs are pre-tax and certain IRAs are post-tax. So they will continue to allow, likely, pre-tax IRAs converting over to Roth IRAs. So this is something that we do every year just to see if we want to take advantage of this. One thing we look at is obviously your tax bracket. We want to make sure that you don't want to convert too much and put you into a higher tax bracket. If you are eligible to contribute into a Roth, you don't want to make a conversion, push your income over a certain threshold and then not allow that Roth contribution anymore. And for those that are age 65 or over, I'm sure you're well aware that Medicare Part B has premiums, and we want to make sure that you're not converting too much where it pushes your income over the threshold. 85,000, I believe, if you're single, 170 if you're married filing jointly. Those numbers change every year. And then you'll end up paying more for your Medicare Part B premiums. So those are things that we look at to see if we want to convert any of your pre-tax to your post-tax accounts. And to get a head start, because we're all planners here for next year, 2022 limits are out. IRA and Roth IRA contribution limits remain the same, except the phase out limits will increase. I believe they're indexed to inflation, so they've actually increased a little bit more than usual this year. 401k contribution limits will increase. It went up $1,000. So this year it's $19,500. This is the salary deferral component part. It's going to increase to $20,500. Same catch up applies. And for those that are on the maxing out their 401k plan, I've done the math for you. 20,500 divided by the number of paychecks is how much you need to save per paycheck starting in January. So make sure you basically update your HR to make sure everything is set and ready to go for January. RMDs, this is a really big deal for the end of the year. So if RMDs apply to you, required minimum distributions, it must make sure you take extra caution to make sure that it gets done. This is an area that the IRS penalizes heavily on. It's one of the highest penalties, I believe it's 50%. if you did not take the correct amount. So RMD age is 72. If you are 72 years old and you have any pre-tax accounts and a Roth 401k, you need to start taking RMDs from this account. So make sure you talk to your CPA and your financial advisor to get the right amount that needs to be distributed from that account by the end of the year. And remember, conversions do not count toward RMDs. RMDs are strictly money that has to be taken out of the retirement account into your bank account, into your non-retirement account. Converting it to a Roth does not count. Inherited IRAs, this I put in here because we used to have to deal with required minimum distributions for inherited IRAs. However, that is not the case for deaths that occurred in 2020 or after. For that, it just follows a very straightforward 10-year rule. Basically, you have 10 years to deplete your inherited IRA. You can do it a little bit at a time. You can do it all at once. You can do it in chunks. Basically, at the end of 10 years, that account needs to be zeroed out. However, if you have an inherited IRA for a death that happened prior to 2020, then you do have required minimum distributions. You've likely been taking them already for the last few years. So this year is no different. Just make sure you talk to your advisor, make sure you're taking the amount out that is necessary, because we don't want to be penalized on that.
Donna, really quickly, if you did inherit an IRA, can you maybe explain the difference about when you should be taking those distributions if you have a traditional inherited IRA or a Roth IRA?
You mean, you're talking about for deaths after 2020, right?
For the 10-year rule, right?
Yeah. So again, this applies differently for everyone's situation, but all else equal, if you inherited a Roth IRA, because it's after tax account already and you don't have to pay any tax on it, why take it out, right? If we can leave it in there forever, we would, right? It's just that they have this 10-year rule. So if you have a Roth inherited IRA, I probably would wait till the last minute before you take it all out, because as it's sitting in there, you don't have to pay any taxes on that as it grows. If you had a traditional pre-tax inherited IRA, that one you will have to pay taxes every time you take money out. In that case, then it's a toss-up, right? Do we really want to wait till the 10th year to take a lump sum? What if that IRA account is $1 million? Do you want to have your tax returns spike and add $1 million onto your income that last year? Maybe not. But is it more painful to take out, $100,000 every single year? Maybe that's less painful for you. But then what if there's a big bonus in year 4? So it's something that you definitely have to decide year by year. But all else equal, if you have a pre-tax account, I'd probably take it out a tenth at a time to spread out the pain. If you have a Roth inherited IRA, probably wait till the last minute before you take that out.
So just kind of to talk about the tax benefits or the tax effect of putting money into your retirement accounts. Contributions to a Roth IRA or a Roth 401k, they don't affect your taxes today, but you won't have to pay tax on any of the earnings in this account. So when you take money out in the future, when you take distributions, when you retire, you won't have to pay tax on any of it. So this is a great option if you have the option to put into these Roth IRAs or Roth 401ks. Pre-tax contributions, they reduce your current year tax. So it's still a good opportunity to save taxes. I mean, retirement is one of my favorite ways to bring down your taxes, because you're bringing down your taxes for putting money away for yourself. So just to kind of illustrate what the tax benefits are, let's say you max out your 401k, you put in $19,500, you're in the 33.3% tax bracket. So your tax goes down about $6,500. So that means that $19,500 contribution only cost you $13,000. It's like you got a 33.3% discount. Who doesn't like a discount? So, but I do want to mention that these pre-tax contributions, they are going to reduce your tax, but that's not going to affect your tax refund. Sometimes people expect their refund to be bigger because they're putting more money away, but this tax deduction is already getting calculated and figured out through your payroll. And so you are getting the tax deduction, you're just not going to notice it when you do your return.
All right, great.
The
So,
one thing I noticed here that screams out at me is a lot of times people forget about the state tax. All of a sudden 24% becomes 33.
Yeah, I know. California. Yay. Okay, so I think we've talked enough about taxes, or at least I have. Let's move on to another important topic. Sophia, it's the end of the year. Is there anything I should do to make sure my estate planning affairs are in order? Do I need to review my living trust?
yes, thanks for asking. And this is something you need to do before something happens, right? Because if you're already in a situation where you're incapacitated or you're not here anymore, you can't make any of these changes. So before something happens, check your trustees and your distributions. Did anything happen during this year? Marriage, birth, death, disability, kids turning 18, retirement, changes in the tax law. I recommend reviewing it every 3 to 5 years just to double check, okay, is this what I want to do? And then if not, you can make changes if you have a revocable living trust. Another thing to check is, are assets titled correctly? Recently had a case where, and this happens so often, it's like, they bought a property 20 years ago, but they couldn't qualify for the mortgage. So they have brother on title with them to be on the mortgage. And then, 20, 30 years later, they look at their title and it's with brother. And if something happens, obviously brother gets it. If you make a change to that now, property taxes could go up. But if you wait longer, property taxes will go even further up. So you may want to double check that. Are the beneficiaries correct? Maybe a long time ago, your kids were little, so you had someone else be the beneficiary, but now they're over 18. Maybe you want to change that. And of course, if you are a trustee, maybe you want to look at the taxes. Trusts are taxed at the highest tax bracket. So if there is any income that's generated in a trust, maybe see if you can flow through that to the beneficiaries on a K-1. And of course, before death planning is so important, because after death, this is what we're going to go through. I noticed that this year, unfortunately, there has been a lot of deaths recently. And one of the first things that happens is find your trust documents, find those documents, check those trustees, who's the next in charge in line to take these documents and go to the bank, sell property if they need to. And that's what a trustee does. They gather assets, they're checking the title. And what do you do when you check the title? Is it in a trust? If not, you might have to be in court. Is there a named beneficiary? If yes, it goes straight to the beneficiary. It may or may not go into your trust or your will. And if there's no trust, no beneficiary, no joint account holder, you might have to go through the probate court process. Another thing people may not realize is when there is a death, the clock starts ticking on when you can file tax returns, certain type of tax returns, property tax documents. You have to let the assessor know. And if it was going to a child, they don't know that. You have to let them know to get a parent-child exclusion from reassessment. That has a time limit. And if not, then property taxes go up. You have to notify heirs and beneficiaries. You have to notify government agents of a passing. Of course, if this is your first time being a trustee, you may not know all these things. So of course, consulting with an attorney is best. All right, I don't think we have enough time for questions, but if there is some questions in the chat, we'll get to those outside of this webinar.
Thank you guys for attending. I hope that you guys found this to be good and relevant information. We wanted to initially actually talk a little bit about Biden's tax plan, but of course it keeps getting delayed, and now we're hearing that it's probably going to get signed right around Christmas time. So it'll be something that we will discuss at our next webinar. We're going to take a break for Christmas and we will reconvene in January. Our next webinar is going to be January 21st. We'll be talking about New Year's resolutions, how to set your new year up, right? As well as all of the Biden's tax plan, essentially. So thank you very much for your time. We will be sending you a short survey. If you can complete that, that would be great. And I hope everyone has a happy Thanksgiving next week. Happy Thanksgiving, everyone. See you next year.